Hello and welcome to Strategic Alternatives, the RBC Capital Markets podcast, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world. I'm Graham Tufts, Global Co-Head of the Financial Sponsors Group. Joining me today are my global co-heads, Ram Amanath and Harold Vara. We'll be discussing the outlook for financial sponsors in 2025. Harold, Ram, welcome back to the podcast.
It's a pleasure to be here.
Always good to chat with you guys.
Yeah, it's always good to get together, and we do this all the time, so it's kind of neat to do it for our friends, colleagues, and clients.
Well, look, we've seen the stats and numbers and the activity for last year. We don't want to turn this into a full predictions podcast. Why don't we share some views here on deal-making environment, what's important to us, what's going to be important to our clients, and how we think 2025 is going to unfold?
Yeah, I think that makes sense, Graham, and I agree with you. Let's start in the deal-making environment. Everyone cares about deals. Everyone wants to read about deals. And certainly it felt like we had a really busy summer, didn't we, last year? We got very, very excited about that. It seemed like there was this wave and rush before the election, and it was a little bit of an inflection point and some really high-quality transactions that we did. And I think it set the stage for this year. The election, I think, probably caused a little bit of a blip in terms of activity. People want to see how that got adjudicated, resolved. And then, of course, people have been feeling pretty euphoric from a markets perspective as we come into the new year. But there's always a lag effect. Again, I think that second half really was encouraging. Deal volumes count were certainly up, north of 20% versus 23. But 23 wasn't exactly a banner year.
Yeah, and look, it's a great point. And some of the issues that we were chatting about a few years ago that was stalling deal activity aren't here, right? We probably couldn't have a better credit backdrop. The L part of our, LBO world is pretty good. In fact, that world, if John Kokonos was here, he would tell you they can't get enough product, right? So we know the leverage there will be there. I think the issue, it's really to deals. And, we have some clients who will want to do deals. And I think the biggest issue right now is there's still a disconnect on private assets in terms of valuations.
Yeah, I completely agree. And I think we're going to have a theme, right, Graham, throughout this on quality, right?
For sure.
Deals that traded at pretty high multiples in 2021, some of 22, that haven't necessarily grown into those multiples. So I kind of feel like you're absolutely spot on, Ram. I think the demand is there. The question is, what type of supply is there?
Yeah, no, totally. Look, it was a different rate environment back in 2021 to where it is today. And undoubtedly, the demand side is there. The supply side is not. Businesses are growing back into those multiples. It's going to take some time, which is why I think the first half of this year is going to start steadily, not a rapid bounce back. We're going to see a build through the year and a busier H2 than H1, I fear.
I guess we're playing the prediction game. We can't help ourselves. But last year, even with the bounce back in volumes in the summer, sponsors accounted for 30% of the overall M&A market. I'll go on record and say we should be back to like those 40% norms this year, because I think you're spot on, Graham. I think the sponsor activity, whether it's through continue to help corporates with their carve-outs, take privates.
I think that's a big one. I think you'll see a lot more of those.
I think we'll be busy across the board. And so I'll go with that prediction. And we'll get to kind of the liquidity and some of the growth in other asset classes later on. Why don't we, to your point about exits and stalling, let's talk about the IPOs. I think to kind of get to a more functioning deal-making environment, you need to see the IPO exit alternative as viable, because it's just so important for sponsors to have that as an option, especially for their larger assets. And I think that hasn't been available. And so I think we've all been trying to will that back to life. And quite frankly, looking at kind of some of the higher quality names that are in our clients' portfolios, looking at where the equity markets are at just exceptional multiples almost across sectors, I think we should fall in line with everyone else and say 2025 should be a constructive year for the IPO markets. Do you agree, Rob?
I do. I think for the largest and best assets, both because I think there isn't another option, as you said.
Yeah.
And quite frankly, that might be palatable to some investors, which is interesting, right? The markets are so high. So you would think, oh, well, therefore, why aren't the primary markets doing well? And as we all know, active managers are becoming fewer and fewer. And active managers are what drive IPOs, not the passive managers that are out there. So we're going to have to find the right alpha for active managers. And our clients are going to have to play the patient game of being in their assets for 3 to 5 years.
Sponsor-backed IPOs that actually managed to happen in 24.
Yeah.
They had a median gain of 21%. So you can say, hey, the asset classes worked.
Yeah,
It worked.
exactly.
It worked. Although the S&P was up comparably. So maybe it was just in line. But regardless, it actually worked. And I don't know, Graham, how you think about that with a European angle, if that's different.
I think from a size perspective, you're spot on. The deals are going to have to be the larger deals. Deals can create real liquidity out of the box. I think the challenge here in Europe is the process that you have to go through. It's not the preferred exit strategy for most sponsors. They like to have it, as you said, as a backup to processes. But the other thing we have at the moment is a differential in just multiples between the US, Canada, and Europe right now, where we're lagging behind across virtually all sectors.
It's interesting.
That is a good point. I'll add one thing, and because with the thematic of larger IPOs, I think there will be a return in the US. I think it's be a lot slower in Canada.
Yeah.
For that reason, there aren't that many very large companies that are ready to go public. And if you are a medium-sized company, which is typical as we would define medium, in the US would be larger in Canada. And if you're private equity backed, you probably have a private capital solution right to sell.
Yeah.
So I think the refunctioning of that market, I think, will take more time.
Last year, we saw tech IPOs be around 25, 30%. It was as high as like almost half of all the tech IPOs in 2021, which is obviously the peak year. So I actually think that the distribution across sectors is going to resemble a lot of what we saw last year. Again, albeit with a smaller sample size, but I do expect, and again, because I think we're talking about quality, we're talking about size. I think you're going to see more healthcare names. You're going to see more industrial names. You're going to see more consumer names, some higher quality services businesses. I think it's going to be more well-rounded. It will not be as heavy as tech as we've seen. I think it's a little bit of what you just said. Of course, we'll see tech. Tech will probably still be the number one sector when we're all said and done in terms of public exits from sponsor backed. But I think we will see more balance. And quite frankly, I love that, because if you're talking about the IPO market, we can't be talking about just a bounce. You don't want to get like, hey, it came back and then it went away because look what happened. You don't want a repeat of 21. And I think a more balanced end market mix of IPOs could lead to a more sustainable recovery of the public markets. I think what we're going to see is a minimum of $5 billion US equity values. I think that enterprise could translate into, call it $78 billion. I think that's where the focus is going to be, to make sure you have that liquidity, make sure that sponsor overhang won't be impacting the potential for a rising share price and therefore more regular way follow-ons. And therefore, I think, again, prediction, but where we're certainly spending time with clients is in sectors where private equity has poured capital in the last 3-4 years. Look for consolidation within those sectors between and among sponsors who will see shareholder value creation in that combination, not just through the traditional synergies, top line and bottom line, but because that scale will allow them to re-underwrite an IPO exit. And I think that's the key. And that's where we're spending time with clients saying, why aren't you thinking about this potential combination? Because that's the path to glory.
As an add-on to that, I'd probably also say that you'll see a lot more cross-border activity. If you look at where rates are today, FX rates, you look at the multiple differentials between the markets, there's going to be a lot more cross-border acquisition activity, and I think particularly US into Europe.
I hope so. We're set up that way, obviously, to benefit from that, whether it's cross-border, US, Canada, or Europe. So I hope you're right, and I think there's a lot of signs that are pointing to that. So let's move on to the fundraising, because our clients obviously live and breathe it. So 24 was obviously a tough year. It feels like the market has been much more constructive. It feels like some of those really slow going on some of the fundraise kind of accelerated as the year went on last year. And I've certainly had conversations with clients that have said, hey, we have our final close in April. We have our final close in May. I'm starting to have those conversations where, at least anecdotally, it feels like there was an inflection point and there's been some acceleration in closings or to be closed.
I think that's right. And I think that plays into a segue of the winners and losers. But going back to LPs, I think some of the issues that they had in being able to put money to work is starting to normalize for a bunch of reasons in terms of resetting of their weightings and getting some money back and being able to put money to work. So I agree with that. And if there's one thing that we called, and I think for sure last time, is this is what we predicted last time. We said the big guys are going to get bigger, and the non-specialist mid-market folks are going to have it a lot tougher. And unfortunately, because a lot of them are clients of Brains, it's been a struggle.
It's been a struggle. I do think that last point is really salient. And I don't know, Graham, if you've seen the same thing in Europe, but the quote unquote mid-market firms, I guess that size could be that $3 to $7 billion fund size on the traditional private equity that were generalists, so cross industries. It's been very challenging for many of them unless their returns were just top quartile, top decile. And so I think what we've seen from a behavioral perspective is that LPs still want to deploy into the mid-market. It's critical to their overall asset allocation, but they're looking to do it on a specialist basis. And so we've seen, and it's been difficult for a lot of these firms, but they've had to go through this transition to be responsive to their investors. And I do think that the winners coming out of this will be more mid-market specialists, and then the mega funds are becoming more mega. And then I think what you'll see is those specialist firms will say, okay, we've heard you loud and clear, investors, LPs, in terms of what you want from us. But you know what? Then support us to do a maybe lower mid-market fund or strategy along the same vertical lines. If you like us in the mid-market, like us the lower mid-market. And so what you'll see is on a vertical basis, them being able to raise more capital, but still keeping in line with that specialist philosophy.
I think that's also true, Hal, for some of the large cap firms, because we're now seeing, certainly here, a number of those firms raising mid-market funds to invest alongside the large cap funds. So we've got big teams here, and finding enough or a number of large cap opportunities is really challenging, and winning those and investing your fund is really challenging. So one or two of them are now opening up mid-market funds as well to keep the teams busy. So, it's an interesting dynamic that we have at the moment, because I think you'll see some of those large cap funds also trade down into that mid-market space. It's going to become quite crowded and more competitive.
I think you're right. I think we will continue to see, as a result of all this, more consolidation among various GPs. And this is, again, to your point earlier, Harold, under the private capital banner, where it's going to be cross strategies, et cetera. We've already been seeing some.
And I think private capital, we've seen actually really substantial overall growth, not only over the last decade of 14%, which is 200 basis points in excess of just traditional private equity. But then if you look from 2020, where you can start to see some of the problems starting around the private equity fundraising, private capital overall was up 16%. So how is it that in the last few years it's been up higher than the last decade? And I think it's because of exactly where you're heading, Rob. Because private capital strategies, such as private credit, hybrid capital, infrastructure, secondaries, with these asset classes, I think exploded is actually a quite proper term. I mean, they've absolutely exploded, especially since 2020, 2021, 2022. And that's kind of led to a tremendous, growth in AUM. But more importantly, what I want to talk about is, how does that change our business as investment bankers running one of the largest, sponsors coverage groups on the street? How do we think about our client base? What products and services are we actually focused on? Because I actually think that our business is evolving in very exciting ways. And I think it's actually going to lead us to have to be a much more broad-based in our approach to our clients. The buying and selling of assets game, that's just a piece of what we're going to have to do to kind of solve our clients' puzzle, because this AUM growth has been so dramatic. A lot of it's been very low cost from insurance companies, and our clients need to deploy it. And they're going to be looking to us, and they have been looking to us to help them. It's really exciting stuff as we transition from private equity coverage to private capital coverage, if you will, sitting in our seats.
That's where our clients are going, and that's where we've been going. And I think we could all say with some of our clients, that's how we cover them today. And we're going to have to continue to adapt and exactly what you said, help them originate ideas irrespective of kind of the asset class.
They're not just looking for, leveraged assets anymore, or leverage investment opportunities. They're moving into the corporate and investment grade space as well. They're looking for us as their coverage guys to try and find other avenues for them to invest and almost be an origination engine for them for some of those asset classes that they're looking to invest in.
That's 100% right. I mean, I think a couple of years ago when we were talking about, I don't know, it's been that long since the last podcast, talking about private credit.
Yep.
We were talking about more in the context of direct lending.
Yep.
Right. What you're getting at is the kind of transition and the growth from just direct lending as a strategy to asset-based finance, infrastructure-based finance, commercial real estate-based finance, structured kind of equity, if you will, into high-grade corporates to solve their problems, be a capital solution provider. And the AUM growth has been so dramatic. Quite frankly, they had to do this. Even it's good business, and they should be doing it. It's obviously up the credit spectrum, but they don't have enough. There's not enough supply of potential direct lending opportunities to satisfy their growth.
There's the supply-demand imbalance, and I think it makes our jobs, I think you guys would agree, even more exciting. So I think to your point, Graham, the origination part of our job, which I think is the most important part, is only ever expanding.
By the same token, I think other strategies have really taken off as well, right? So like infrastructure, which is just such a big core part of our business. I just mentioned the context of private capital, private credit, but it's certainly just the infrastructure investing funds, which used to be maybe a subset or an arm, is now really just taken off as its own strategy over the last few years. The heavy, hard assets have just been more resilient as we've kind of had different cycles. And I think that investors are really looking for uncorrelated returns and stable cash flowing businesses to complement some of their, perceived higher risk, investments, and I think that the infrastructure deal environment has actually been much more stable these last few years. We've seen, like, again, more traditional private equity deal volumes down almost half through kind of peak levels. The infrastructure investing environment's kind of stayed normalized, and the deals have become bigger and bigger because we're dealing with asset classes that are enormous. If you think about some of the hard asset classes that, power, energy, transportation, these are just huge parts of our economy.
Data. I mean, now the pipes that infrastructure is now solving for is data and fiber and communications,
right?
And
the digitization of our economy.
Yeah, absolutely.
They're at the intersection of it.
That whole comms infra space has grown enormously over the past 2-3 years. Absolutely enormously. Partly on the back of AI, but just the whole data consumption piece has just changed considerably. And the other thing, and I guess you guys will be seeing this too, is the advent of impact and ESG focused funds that are investing into the energy transition space, but also all the associated businesses, services, and suppliers to those sectors as well.
Why don't we talk a little bit about some regional aspects? And this is kind of where we can kind of have fun. We'll try not to be too political. Even though politics seems to blend into everything that we do these days, it's kind of hard to avoid it. But, Ram, when does the leadership vacuum in Canada get resolved, in your opinion?
It'll be sometime between May and October, depending on how things shake out. What's interesting, and look, we, again, not to get political, but there's a lot of reasons why, and this was before the tariff threats, there's been a greater disconnect between Canada and the U.S. in economic performance than I think there has been in many, many years for a host of reasons. But if you go back just a few years ago, I think the overnight rate in Canada and the Fed's fund rate in the U.S. were on top of each other. Today, I think most economists are thinking there's going to be no more rate cuts in the U.S., and that's consensus, and maybe even a rate hike, depending where things go in the U.S. I think our economists think there'll be another 5 rate cuts in Canada. So there's a major differential in what, both the expectation for the economy and the required boost and where inflation's heading, et cetera. And a lot of that has to do just with growth. Next year, our economist is thinking before all of this, Canada will be at 1%. The U.S. is more than double that, which is a big difference, right? And, the currency is, you've seen that dispersion, and that's already been reflected in that. I think we're kind of at 68, 69 cents today. I'll just say the last time we saw this, where there's a lower growth environment, a major differential between the Canada and the U.S., and the currency kind of where it is, sadly, as a proud Canadian, we saw a lot of hollowing effect of major corporations in Canada, right? It was an opportunistic time for global champions, especially US, to come in and look at opportunities, right? I think there's going to be a lot more transaction activity going forward, and a lot of that will be cross-border.
Right. Because a lot of these companies, notwithstanding what you just said about the overall growth prospects, are global businesses.
Sure.
They may be trading on the TSX or what have you. They may be operating with employees in Canada.
Not surprisingly, a lot of Canadian businesses today are not doing a lot, kind of seeing what's going to happen. But I think we'll likely see, as we do in environments like this, M&A increase.
I guess the new administration, whoever that happens to be, could be either more friendly or less friendly from a regulatory perspective.
Yeah, I mean, the prediction will be more today, but we'll see where that goes. I think with our clients, I think already seen a lot of that, where not just with local private equity firms, but global private equity firms looking at Canada. And I think you're going to see more of that.
Given our market presence and within the Canadian market, we'll obviously be at the intersection that will help these companies, but also help our clients globally to the extent there's opportunities, whether they're private equity or otherwise, to kind of, I guess take advantage of it, but hopefully also, potentially be, again, that capital solution provider, because it doesn't have to just be M&A. There's lots of ways that our client base, to our earlier conversation about the onset of private capital, can help these companies through whatever it is that, whether it's balance sheet considerations, CapEx considerations, potential M&A that they need dry powder for, et cetera. Like all these could be very interesting for us, just given where we sit in Canada, our market leading presence there, to be able to help our clients globally.
Yeah, absolutely.
Look, the European project is facing some economic challenges at the moment, and that's impacting growth. We're going to hopefully see continued and progressive rate cuts, both in the UK and Europe throughout this year. We need that. But if you think about it from an investor perspective, the dollar funds look really strong. I think that valuations here look comparatively weaker than in the US. I think that opens up a lot of opportunity for the cross-border deals that we've been talking about on this podcast. And I think we'll see a lot of P2P activity here in Europe as well, because valuations aren't responding the way they have in the US to the Trump administration. And it's going to be tough here. And I think the other aspect here that we also need to take into account is China, because anything that impacts China's a big trading partner still of Europe, and that will have an impact here as well.
Thank you, Graham. I really enjoy anytime we can get together and talk about our business. Incredibly excited about how all of these different trends we're talking about manifest themselves in the next few years. And hopefully will just be record-setting years, not only for us, but also just delivering for clients like we've never done before. And so, again, thank you, Ron and Graham.
You guys.
It's always an absolute pleasure.
If there's a theme, there's never a dull moment, and it's a lot of fun working with you guys. So thanks for the time, and this is always fun.
The listening to Strategic Alternatives, the RBC Capital Markets podcast. And this episode was recorded on January 30th, 2025. Listen and subscribe to Strategic Alternatives on Apple Podcasts, Spotify, or wherever you listen to your podcasts. And if you enjoyed this episode, please leave a review. There's a lot more that you can listen to, and hopefully we'll be back at you soon. But please, we also welcome any comments, any feedback, and look forward to engaging with all of you going forward.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.